Good morning, Flagship Harbor Advisors. Eric Jefferson, CIO of the core team. Today is March 14th. Happy Pi Day to all you math enthusiasts. Just a reminder, this replay is for advisor use only. Recapping last week, S&P down 3%, bringing year-to-date in the red 11.5. Two stories there were further escalation in Ukraine, as well as record US inflation, the highest it's been since 1982. I think the bigger story was actually on the bond market. We saw yields climb very significantly. Will actually tie into a trade that we made we'll discuss in just a moment. On the positive political front, Congress passed omnibus spending to fund the federal government through September of this year. That does two things. First, takes the potential of a government shutdown off the table. Secondly, based upon less spending, the deficit set to now fall sharply from 2.7 trillion, which represents about 12% of GDP, down to just over 1 trillion. Now that's provided there's no major legislation, which I think is very unlikely ahead of a midterm election, especially where the GOP is expected to pick up a number of seats in both the House and Senate. That's also potentially a positive catalyst for markets. Again, as a side note, we talk about midterm elections tend to be more volatile. That's based on the uncertainty of the political landscape going forward. As we all know, markets tend to perform best when you have a split government because companies don't have to worry about potential changes. They can go out and simply run their businesses. So again, assuming that expectation does play out, I think that could potentially be a positive catalyst longer or towards the end of this year. Going back to Russia for a moment, we saw an attack on a city 10 miles from the Poland border, where that's obviously very important. Poland, a member of NATO, and the US has come out, mentioned we are prepared to defend every square inch of NATO. The concern is if Russian aggression eventually spills beyond the Ukrainian borders, what response will that trigger? The other story to focus on, we saw a headline over the weekend from US officials that Russia asked China for military support. Don't know exactly what the specifics were there, but if you recall earlier this year, China and Russia published a statement indicating there were no limits on their friendship and partnership. US and China officials are set to sit down earlier this week. Obviously, the expectations if China came to Russia's aid, there would be very swift sanctions imposed by us. Obviously, China has a lot more to lose being pushed out of the global economy than Russia. It will be very interesting to see truly what limitations that partnership does have. Other headlines out of China, we saw a few COVID cases pop up with their zero tolerance policy. They've now instituted 1-week lockdowns in several cities. As a result, you saw Chinese equities down 3.5% in early trading. One of those cities in particular where iPhones are generated or built rather, that further fuels concerns over impact on supply chains and that inflation narrative potentially sticking around for longer than expected. Obviously, higher prices are starting to have a negative impact. We've seen consumer sentiment the lowest it's been for a while. Now, we're not in recession today because we obviously spend a lot less on energy than we did in the 1980s. We have very healthy US consumers with excess cash, but that excess cash has started to be drawn down based upon those higher prices. The question is longer term, how does this play out? The probability for recession today is still low. That's based on the expectation that inflation will begin to correct. But clearly, the probabilities of recession are biased towards the upside. Goldman came out of the weekend, indicated chance of a recession around 15%. That was up from single digits a week or two ago. The other side of combating inflation, this Wednesday, we'll hear from Fed President Chairman Jerome Powell, all expectations for a 25 basis point rate hike. As we talked earlier, response in the bond market, we saw yields climb very significantly last week. The 10-year rose from 174 to 207. That's not surprising, given the fact that I think a lot of the safe haven buying in treasuries as a result of Ukraine has somewhat subsided as well. When you think about high inflation, most investors selling bonds to not lock in, that set rate that has negative real purchasing power. But based on where we are today, we are starting to be more comfortable with duration. Again, we think about the Fed's mandate for full employment and curbing inflation. Obviously employment numbers are very strong today, but Powell's obviously smart enough to know if he raises too aggressively, that could trigger a recession, have negative impact on full employment. And so our expectation is actually for Powell to take a slightly more dovish approach here to hiking rates. Expectation is maybe more for 5.5 as opposed to market expectation of 7. So as a result, last week we actually took off a inverse 20-year treasury trade. That was ticker TBF. That did very well, outperformed the ag by about 150 basis points during the holding period. And that even factored in the initial flight to quality immediately following the Russian invasion. Related to that, and again, the expectation that rates may be somewhat range bound here in the short term, we exited a position in financials and banks, both of those tied to a steep yield curve and higher interest rates, as well. Financials in particular face several headwinds. Earnings have lost a little momentum. You've seen IPOs down 93% year to date versus last year. Two other trades we made, exited position in European stocks. Obviously just want to get a little more comfortable with how that situation will play out longer term, and took proceeds into elevated cash as well as silver miners. The latter really just to play on that continued inflation. Interestingly enough, silver miners have not appreciated to the same degree the underlying spot metal has. Thought process is if those commodity prices do remain elevated, that is going to be a higher profit margin for those miners. When you think about road ahead, future trades on our radar at some point here, if we do get comfortable or progress with peace talks between Russia and Ukraine, that's something that would obviously trigger us to go risk on. We also are warming up to technology. That's an area they have very strong balance sheets, benefit from a slowing global growth environment. Again, our forecast still about 3.5 for real GDP this year. If anything, that's biased to the downside. And obviously tech valuations with the now nearly 20% correction have become much more attractive relative to what they were, I'd say, even the beginning of this year. Two core specific items. One, we did recently put together a muni portfolio. We'll send the details of that around. That marries the strategic equity allocations with tax-free bonds. That's available now in all 5 investment objectives. As well, for that model and for any others, we recently published a client transition letter. Something if you are interested in taking advantage of these portfolios, a great way just to initiate that conversation with clients. And then a housekeeping note, there will not be a video next Monday, so don't look for anything coming out on the 21st. Obviously, though, will be available for any questions over the phone or email. Outside of the investment world, just a friendly reminder, daylight savings over the weekend. Make sure to turn any of those non-digital clocks 1 hour ahead. As well, we saw the greatest of all time, Tom Brady, TB12, announce putting off retirement. I do certainly feel for the fan that paid over $500,000 for his last touchdown ball. That's all for now. As always, please let Mike Lana know if there's anything we can do to help. Have a great week.